Now, this one's going to be really, really, really fun because we're going to be looking at market efficiency. And for some reason, this is something that a lot of students struggle with. And my hypothesis is because this is typically taught at the end of your module. So you already went through CAPM, you already went through modern portfolio theory and options. Like the last thing you want to cover is efficient market efficiency theory or just EMH. So what we're going to do now is we're going to try to make sense of what weak form, semi-strong, and strong form efficiency is all about. And I think I made a really fun graph or visual aid that could help you make sense of it. And then we're going to go through 5 questions in which we're going to test our graph and test our understanding of what EMH is all about. So let's give it a shot. So as you can see right here, I actually have 3 circles and a rectangle 3 different times, and it looks like a whole lot of nonsense. But what I tried to do is I tried to represent what weak form relates to in terms of historical data, public data, and private data. Then I tried to do the same thing for our semi-strong form and our strong form. And what I need you guys to be able to understand is that efficient market efficient what did I even say? Essentially, what I'm trying to say here is that efficient market theory deals with 3 components. We're trying to see to what extent are prices influenced by historical data, public data, and private data. And this hypothesis tries to categorize these different, types of data onto different types of market efficiency forms. So, as you can see here on our graph, we have the first form, which is weak form. And weak form essentially says that only historical data is represented in the prices on the market. Now, if you could quickly understand, is that what I'm trying to do here is I'm trying to represent what is being represented in the stock prices by my arrows. And this is done for all the forms. So semi-strong form has 2 arrows and strong form has 3 arrows. Now we're going to try to break down what these arrows mean and how they relate to, weak form and semi-strong and vice versa. So as I said, the weak form efficiency, okay, weak form efficiency essentially argues that historical data has to be represented in the prices of the securities on the market. So, what does that mean? What is historical data? Historical data essentially means past prices. And that's something that I know we all do, AMC, keep it to the moon, all that meme stock type of nonsense. And we essentially say, well, if the moon comes out every second day, and if I drop my calculator in this way, and this person coughs, well, I should buy a stock. And if, vice versa, I would sell my stock. This is what this is a very bad way to discuss what technical analysis is all about. And technical analysis essentially it tries to look at historical data and create some sort of trend or observation that can be repeated onto the future. And that's what weak form is totally against. So if you could make abnormal returns by looking at historical data, well, we're actually breaching the number one rule of a weak form market. Because a weak form market, as I said, says that historical data is represented in the prices, such that you could not make abnormal returns from looking at historical data. However, what weak form means, it also means that public and private data are not represented in the prices of our markets, of our stocks. Okay, so that's totally super important for you to know. So if a weak form market would say that historical data is represented in the prices, but public and private data aren't necessarily represented. So, another thing that I want you guys to be able to remember is that when we discuss this concept of weak form efficiency, we're definitely arguing against this idea of technical analysis. We're saying that technical analysis could actually not benefit investors because all of the historical data, all of the trends, or whatever are represented in the prices. So there's no benefit to doing technical analysis. Now, is that the case in the real world? I don't know. I think it's not necessarily the case, but that's more so speculation. So, another thing that I need you guys to be able to understand is this concept of random walk. This is something that you're going to look much more further in detail as you progress through your finance courses. But for the scope of Comp 308 or, a simple introduction to corporate finance course, You want to know that a random walk essentially says that past prices or random events in the future are not going to essentially cause any randomness to today. And I feel like no. So essentially, what random walk says is that a price of a stock follows its own random walk. It goes in its own random direction, regardless of whatever has happened in the past. So, an abnormal return or a specific event in the future will have zero consequence on the price of a stock today. So, whatever event you've witnessed or you've observed with your technical analysis will actually be literally useless because stock prices follow a random walk. They don't care about what happened in the past. I feel like that's a pretty good blanket way of understanding what random walk is and how it relates to technical analysis and the weak form market efficiency or the weak form of market efficiency. I don't even know how to really say it. Essentially, you just want to know that this is the weak form. So, with that being said, let's cover our semi strong form. And the semi strong form is really cool. So, as you could see, the first thing you should notice is that the semi strong form carries over from our weak form. Okay. So, essentially, whatever we've discussed in our weak form also applies to semi strong form. But we're adding one component, the idea of public data. Now, please remember that my arrows actually showcase what's represented into prices on the market. So, under semi strong form, it becomes obvious that historical data and public data are represented in stock prices. That's what my arrows are all about. They're trying to show you, they're trying to tell you, hey, historical data and public data are represented in the stock prices. Okay? But what this means to you is that under semi strong form, only historical data and public data are represented in prices. So, by that same token, this would mean that private information is not represented in prices, such that under semi strong form, people could actually benefit from insider information. They can benefit from insider trading. And that's something that's actually worth writing here. So, remember that under this form, okay, under this form, under semi strong form, people could actually benefit from insider trading. Okay, that's something super important to know. So they could benefit from insider trading. And you want to note that public information is showcased under the semi strong form. All right. Now, the last but definitely not least is the idea of a strong form market efficiency. Now, as you can see on your screen, you quickly see that we have the same arrows as under our weak form and the same arrows as under our semi-strong form. Okay, but we're adding one more arrow. One more element, okay, is being represented in our prices, and that's the concept of private data. Private data under strong form market efficiency is actually represented in the prices of our stocks. So, I mean, just look at our beautiful graph. It says historical data, public data, and private data are all represented in the prices of our stocks on the market. So, this would mean that historical, once again, public, and private data should be represented in prices if markets are efficient. So this would mean that investors would actually not benefit from technical analysis. They would not benefit from insider trading. All right. These things would not benefit any investor whatsoever, such that when we have a market that we deem efficient, historical, public, and private data would actually not benefit any investors because all information would be steadily available for people. Historical information would actually be non consequential because stocks follow a random walk, and people would typically have no incentive of doing anything related to insider trading because everything is fully transparent and available to everyone. All right, so that's the idea of why these graphs are relevant to you. And another way that I like to help students to get a better feel of how these different ideas of data apply as we go through different forms of market efficiency is through the following, this little pyramid. And what I want you to see here is that a pyramid does not exist without its foundation. And a market efficiency will not exist without its foundation. And efficient market only happens if it has a semi strong market to fall on. And a semi strong market will only happen if it has a weak form market to fall on. So what I'm trying to say here is that all these different, historical, public, and private data all compound with each other as we go through different types of markets. All right, different types of market forms. So that's just another visual representation that you could use to make sense of what we've discussed here. And now we're going to go through five different questions, get a better feel of how everything we've just discussed now makes sense. And these are questions that you definitely will see on your exam. Maybe not the same thing, probably not the same thing, but they'll be extremely similar. And we want to be able to identify the points that are being discussed within these questions and see how they relate to our visual aid. I mean, on an exam, you are typically allowed, especially in an introduction to finance course, to have a formula sheet or a cheat sheet. And just by honestly understanding the intuition of market efficiency and how different elements are being represented, are being showcased within our prices is so fundamental.